Hi, if you invest in tax-free bonds, this video should be very helpful for you. I'm Glen Rosenberg, and I'm going to demonstrate to you how to grow your wealth using tax-free municipal bonds without any fear whatsoever of inflation. Now, before we get started, we need to address two subjects. The first is that many bond investors have a lot of their experience primarily in equities, and consequently, when they're looking at bonds, they're thinking in terms of profit and loss. Now, if you've never done so, I'd like to ask you, at least for the duration of this video, if you have any thoughts that come up with regard to profit and loss, I want you to simply let go of them for a moment, and instead of focusing on profit and loss, I want you to concentrate on the concept of income, because this is why we buy bonds. We buy bonds for income, not for profits. Now, the second subject is that what you do with your bond income is completely up to you. You can use it to live, but you can also use it to reinvest for the ultimate goal of growing your wealth. Now, with that being said, let's get right into the demonstration. This demonstration is a hypothetical scenario, of course, so I'm going to assume that reinvestment rates are consistent, and I'm also going to assume that all the bonds that we're going to talk about pay and meet their redemptions and so on. So, if we were to take $1 million and invest it in 5% tax-free bonds, that would produce $50,000 per year of tax-free income. Now, if we took that $50,000 and bought new bonds every single year, compounded at the same rate of return, times 10 years, that would grow our $1 million portfolio to $1.7 million by the end of that 10-year period, and the income would have grown from $50,000 to approximately $77,500 per year of tax-free income, which, by the way, is a 55% increase over the original year. Now, with our hypothetical portfolio here, you might have a couple questions. What about default risk? What about inflation risk? Well, let's address default risk first. Keep in mind, with any growth-related investments, there's going to be risks associated. I think you would probably agree. Now, with bonds, it's no different. There's certainly risks as well. However, with those risks in mind, consider this. S&P, the ratings company, Standard & Poor's, found that BBB-rated municipal bonds compared to AAA-rated corporate bonds between 1986 and 2008, a 15-year period of time, that BBB-rated municipal bonds had a superior safety record when compared to AAA corporates. And we're talking about companies like Exxon, Microsoft, and the like. All right? Now, despite those extraordinary safety records, we're still going to mitigate that risk by making sure that we buy only $25,000 to $50,000 per position, which would, in our $1 million portfolio, limit our exposure to 2.5 to 5% per position. Very well diversified. But the interesting thing is, by the 10th year, when we arrive at around 1.7 million, a $25,000 bond position would represent only 1.5%, and the $50,000 position would represent 3%. We would become more and more diversified as the strategy continues. All right, now let's get right into inflation risk. The answer to the question, what about inflation, at least my answer, might shock you. Because my answer is that inflation would be a good thing. Yes, it would be a good thing. To fully appreciate why inflation would be a good thing, I have to ask you to, once again, remind yourself to not think in terms of profit and loss, but again, think in terms of income and the reason why we buy bonds in the first place. And now let's consider three very important points. Number one, all the bonds that we're going to own in this portfolio, as I'm sure you know, will have a maturity date. despite any fluctuations in value during the time that you own the bonds. Sometimes they'll be worth more than you paid, sometimes they'll be worth less than you paid. But you'll know that come the maturity date, your bonds will pay off at face value. Number two, the income that these bonds pay is fixed, hence the term fixed income. Now, again, despite any changes in value during the time that you own them, nothing changes with the income. The income remains the same. So that's very, very important to consider. And then third is, we're going to be buying new bonds every year. Now, this is a very important one as well, and this is critical to the strategy and why there's inflation protection here. First, as we buy new bonds every single year, imagine the first 5 years if interest rates remain flat, but in the second 5 years of our 10-year example, what if interest rates skyrocket? Well, if then we're looking at 8, 9, and 10% bonds, during that time we're probably going to be buying somewhere around $350,000 to $400,000 worth of new bonds over that 5-year period. But we're going to be buying them at 8, 9, and 10% yields. Is that a good thing or a good thing? Okay, that's a good thing. So with that in mind, we have inflation protection built in. And it's literally these three factors that quite literally they transform our thought process on inflation with regard to investing in bonds. Now, you might be in your 70s and 80s watching this video and you don't have any need for growth. But maybe your children do. Maybe your children's children do. If they do and they're tired or don't feel comfortable with the stock market volatility and fluctuations for whatever reason, here's a beautiful alternative for them. This is what I do. And this is a way that they can grow their wealth by using compounded growth. They'll have automatic inflation protection built into their strategy. If inflation occurs, it puts them in a better position and accelerates their plan. And then ultimately, they have less speculation in their plan because as opposed to other types of growth-related investments where we're speculating on some sort of increase in value in the future, the increase in value here is based on taking the income that we receive every year and simply buying new bonds with it. And isn't it nice to know that if something ever happened to your earned income, that you've got, by the end of the 10th year, almost $80,000 of tax-free income coming in automatically every single year, like clockwork. I'm Glen Rosenberg. This was growth versus income with regard to tax-free municipal bonds. Hope this was helpful for you. Check out all the other videos, and we'll catch you on the next one.